Well, hello and welcome back. This year, as always, I'm covering a very small session updating you on how our portfolios have been doing. Now, obviously, it's been a bit of a tough few years, really, for investors, as we've seen markets reeling from Brexit bad news, China trade wars, and of course more recently a pandemic. So it's not been an easy time to do this job, but let me tell you a little bit about what we've been up to and hopefully give you some encouragement as well. I want to start by showing you an amazing slide. Now, can you possibly not look at the yellow line? Just put your hand over it. What you can see here is the first 34 days of some of the biggest crashes of all time. We've got the purple, blue and black line, which are the sort of quite famous 1987 crash, the Great Financial Crisis crash of 2008, and of course that crash that we were all brought up on as children, the 1929 Wall Street crash, the three bad boys of the market crashes. However, if you then look at that yellow line underneath, that, folks, is what we've been up against. This shows you the recent crash back in March and April and how the market just absolutely tanked down to minus 37% in under a month. This is absolutely incredible. We've never seen anything like it, and it's just as well, actually, that the Federal Reserve and other central banks stepped in the way they did, and I've told you a bit about that already this morning, as you will recall. Let's have a look in more detail at how our 8 model portfolios held up. Now, we pay a company called Financial Express for their detailed analytics tool, and it means that we're able to feed in all the data about our model portfolios and then get independent assessment on how those portfolios have held up. Now, of course, our models are never exactly what our clients hold. They're very, very close. They'll certainly be the same funds and percentages, but there will be slight movements and variances dependent upon underlying charges and, of course, the times that we carry out the switches. Nonetheless, this chart is really fascinating. Look at that yellow line. That is a FTSE 100 tracker over 1 year, from May 2019 up until the end of May 2020. And it shows how the FTSE 100 tracker fell so steeply. Now, why a tracker? Well, I come up against this all the time within our profession, where many people will say, oh, you don't need fund management, you don't need an IFA running your portfolio, all you need is some cheap trackers. They'll track the market, markets are perfect, you can't exploit them to any gain, you may as well not pay the charges. Well, I really disagree, and this slide proves my point. Here are our 8 Thomas & Thomas portfolios, and every single one of them managed to squeak in over that year without a loss. And that's remarkable. Look at the mainstream level 5, which is our highest risk portfolio, managing somehow to lose nothing. And then the other portfolios then gaining, some of them gaining reasonably well, I suppose, in the current climate. Now, I've put on the top our greatest ever achievement. And do you know what? I really think this is. And the reason I say that is that, this is your money. This is your financial plan. This is your future. And there's nothing worse for us than having to present a point where our client's portfolio falls below the line. And in this instance, we can show that, we got back quite quickly. And that's very exciting for us. And that really makes my job worthwhile. Okay, so I now want to look under the lid of a couple of our model portfolios just to share with you some of the things that have been going on. And it gives you an indication. If you haven't got one of these, don't worry. It gives you some sort of feel as to what's going on. And of course, everything is always covered in your full personal reviews anyway. Now, this is our mainstream Thomas & Thomas Level 3 model portfolio. I'm going to look at our mainstream Level 3 and our ethical Level 3. And the reason I'm going to look at both of them is because broadly these days, our clients are split down the middle. About half our clients hold a mainstream portfolio, and about half our clients hold an ethical portfolio. Now, as you know, we talk about risk from level 1 up to level 5, and level 3 lies in the middle, so it made sense to look at the middle one and to look at the comparisons. So you can see our level 3 mainstream shown here with the funds and percentages that we're currently using for you if you've got this portfolio. Let's have a look and see how it's been doing. I want to start with this chart. This is just a fascinating piece of work. Again, we've pulled it from Financial Express, and it shows our model portfolio in blue versus a Legal & General FTSE 100 tracker. Cheap as chips, that's in red. Now, if you look at it, you can see in the early months, back in June of 2019, that tracker did better than our model, which we never like to see, but it will happen in certain instances, and everything's okay. But as time moves along, and certainly as you come into the second half of the year, look at that. You can see how the Thomas & Thomas model doesn't fall as far month upon month as the FTSE 100 tracker. Now, why am I getting so excited? Does that really mathematically make a great degree of difference? Well, let me show you. Here we go. This is a 1-year chart. Now, as you know, we always talk about 5 to 10 years, but it has been such a year. Let's just have a look at that 1 year, and this is just fascinating. The red line is the Legal & General FTSE 100 tracker, and it loses 12.66% over 1 year. The Thomas & Thomas mainstream level 3, however, manages to actually go up by 3.44%. That is no mean feat when you've got the bottom sliding out from underneath you with the markets. And so this is really good news. Now, yes, it fell. Yes, you can see it went below the line. But those small victories month upon month meant that we weren't losing as much, and that gives us a much better starting position for when recovery comes. And it will come, folks. I think it might be a little while longer, but it will come. Now, you might say, well, yes, okay, that's great, 3% over a year. It's hardly worth writing home about. And yes, I know markets have been terrible, Darren, but 3%, well, okay, it's a bit better than the bank, I suppose, but is it really worth it? Well, as I said just now, we try and look at longer periods of time, as you know, and we always try and look at, 5 to 10 years. Now, here's a chart that I've pulled off of the Old Mutual site, where they have historical information about all the switches I've ever made for my clients. And you can see here a dark green line and a light green line. That's because Old Mutual's colours are this, and so they use their own colours. But this is really fascinating. The dark green line is, again, a FTSE 100 tracker over 5 years. Same one. And you can see it does grow over time, but it goes all around the houses. And of course, you can see that recent terrible drop. The light green line is our model level 3 mainstream portfolio, which shows you as well little dark green dots on it. If you can pick them out, those are the points that I've made important switches for you. Now, it doesn't take much of a genius to see that the mainstream does better. It comes in at about 29.65%, give or take, over 5 years. Now, that's not terrible. That makes it worthwhile. Not fantastic, I'll agree, and of course we're looking at it just after a terrible drop, but it certainly gives some perspective and hopefully some reassurance. Let's move on. Here's our ethical level 3 portfolio. Now, our ethical level 3 portfolio will be narrower because it will try and screen out things like animal testing for cosmetics, poor human rights, things that may hurt the environment. It will have no oil. Now, having no oil has been just the ticket over the last year, and it's meant that our ethical portfolios have done much better. Does that mean we put more work into them? No, sir. We put the same amount of work into both. But what it does show is the ethical is finding a market, shall we say. Will that continue? I think there's a good future for ethical. However, I don't know if the gap between the two will continue to be so wide. I think oil should recover somewhat, but at the moment the picture is very encouraging indeed. Let's have a look. So the same chart over the same date range exactly as the mainstream. As you know, the mainstream was up. It was up by about 3%. This one, the ethical 3, so the same sort of risk taken, same designed by us, but it's an ethical fund portfolio, actually up by 5.79% over the year. Now, of course, it varies day to day, and it varies big time at the moment. You know, things are moving around a lot. But nonetheless, it gives you a direct comparison, and that's interesting. Now, please don't think we're saying that that's always going to be the case, but if you have had ethical, you can feel perhaps a little bit smug right now, and if you have had mainstream, I think you can still feel very happy with your results, and it's just good to show all sides. But what about the 5-year? Are you ready? Well, here's the same 5-year chart then for our ethical level 3, taken from Old Mutual's data, showing those dark little green dots of where we've completed switches and rebalances for our clients. And wow, look at that. It manages to ride on top of the FTSE 100 over the 5 years pretty much consistently, never gets in any trouble, look. Is that a guarantee to the future? No, no way. But wow, that's great to see, and it doesn't fall as much, look, in that bad crash, which means again it gets away again quicker. So this really is giving the FTSE 100 an absolute lesson in investments and investment management. So is it worth paying for advice? Oh yes, I think it is. Well, let's have a little look now as we come towards the end of our session at a topical thing, and that is property investment. I want to just talk about how we usually invest. So normally we would subscribe to Markowitz principles. Harry Markowitz was a real genius of the 1950s who argued that you shouldn't go racing after one particular stock, one particular fund or asset class. It's important to diversify. And one of the ways we do that is we look at the top asset classes. So we look at the sort of the groupings, and they would generally be equities, that's shares, fixed interest securities, known as bonds, and property. Now, property is a very interesting asset class because you actually will buy into a fund that buys then commercial property, office blocks, retail outlets, and so on. And what that fund manager will do is they'll allow you to buy units within their property fund, and you can sell them as well. So they're quite fluid normally. They're a great negative correlator historically, so they should behave differently historically. However, we started to get a bit concerned right back in 2008. There was a blip, and the blip occurred because people wanted money out of their property funds. Now, where a fund manager gets into trouble is if they've got more money going out than is coming in, because these are real physical bricks and mortar funds, and therefore the fund manager has to literally force sell property. And if they can't sell it, they have to suspend the fund until such time as they can do so. This means then that our investors can't get the money out of their property funds, and in 2008 that caused us real issues because we couldn't then very easily rebalance portfolios. It sort of stuck everything up really. Now, at the time, the property funds themselves looked okay. It was actually due mainly to the fact that people just wanted money out, and therefore they were raiding their property funds. In 2016, however, we really did start to get a bit twitchy as we saw the Brexit vote leading to a lack of confidence in Britain in general at that stage, and British property funds really, really struggled, and so they suspended all over again. Then as we came into the beginning of last year, of course, we had all that, was it going to be an extension or not, all the worries, and we started to think, do you know what, we may have to pull out of this asset class altogether for our clients, which is something we just don't normally do, and that's why I'm just telling you about this today. The decision came because we looked at it and realised, when we looked under the lid, that a lot of these fund managers were holding massive amounts of cash. And the reason they were holding huge amounts of cash was because they feared the very thing we did, and that is that they would suddenly get a run on their fund and that they wouldn't be able to pay out. And therefore, they were no longer buying properties, they were just stockpiling cash. Our worry on that front is that a property fund is very expensive to run. It might well have real advantages in certain markets, but you do need it to be invested. Holding it in cash and paying high charges, really to our mind, was not the best value for our clients. And so we made the call to come out. But did we do the right thing? Let's have a look. So this slide is really interesting. It's an average collected by Financial Express, and it shows you the average of property unit trust performance over the past year since we said to you all we need to take you out completely. We swiftly got everybody out in June of 2019 without penalties. And you can see that really things looked fairly okay afterwards. And in fact, this is the most frustrating part of my job, because often I'll look ahead, see something and think, you know what, we've got to call it on this. And actually then the funds just carry on up, and it can be really, really, really annoying. However, I get to be a bit justified here as I see. Look at that. We had a little blip around December, actually, if you can notice it. That was because a couple of high-profile property funds got into a bit of trouble, suspended, but then things lifted again, and then here we go, bang, just as we come to sort of mid-February, end of February, those property funds started to fall heavily, and indeed they're now suspended all over again. I'm glad I got us out. Now, it doesn't mean it's never, never, and I would like to see us get back into property in future, but we'll be looking for the right time to do that. So finally, I just wanted to share with you what our team is looking at as we come up to the September quarterly review. We'll be meeting with fund houses, we'll be doing a lot of stuff obviously over Zoom and Skype and all of that to try and get to the bottom of 4 main concerns or questions we've got. And those questions are, as you may know, we've got a couple of trackers within our portfolios. Now, I've just spent this morning running trackers down, so you might think, well, why have we got them? The reason there are a couple within the mainstream portfolios is to try and save on costs. However, we feel that trackers are starting to run out of steam, so we're looking carefully at this. Is it time now to switch out of those? So that's the first thing, but we need more data first. The second question we're asking ourselves is interest, or are interest rates going to stay at record low levels? Indeed, are you going to end up having to pay your bank to keep your money there? I think there's a possibility of that, and I think at this stage we can say we should see low interest rates for a long time. However, what if they were to lift? How would that affect our bond funds in our level 1, 2 and 3 portfolios? So that's something that we're analysing, ready for September. The third thing we're looking at within our ethical portfolios especially is, are we overweight US? Now, you know I'm quite bullish on US, you've heard that this morning, but you never want to have too much of something. So again, we'll be rechecking that one. And finally, as you know, in my emergency review back in April, we asked you for us to be able to trim back emerging markets, which I think was a good move. However, is it time, is it safe now to increase the emerging market sector? So those are the 4 key points that we're going to be probably looking at. Watch this space, but what I will say is I know it's not been easy for the last few years for investors in general, but hopefully you've been able to see that the journey with Thomas & Thomas has been far, far smoother, and we will keep being diligent to make sure we get you there. And I do know that there will be that big leap back, but I think we might be waiting now, perhaps to the middle of next year to see that, but it will come. So I'm just finishing off then by reminding you that you can ask me any questions you want after today's session. Just email me and I will get back to you as fast as I can with an answer, and I may be able to answer some as well in our live little video session at the end of the day. Now, next up is our final masterclass session, led by Katie, as she shares the results of our recent client survey, updates on Old Mutual, and news about our beach clean. So you now need to just close this one down and click on the next link on the same email to watch that session. Thank you very much and all the best.